Hey everybody, it's Kevin, a CPA that does financial planning, and today I wanted to talk about the last week and a half. So, after nothing but up days, months, years in the market, we've now had more than a 10%, which is called a correction. And so, I just wanted to discuss it. I'm not going to try to tell you how you should think about this. I think the important thing is just to discuss what I find is a way to help myself and help clients deal with these market situations. And so we're looking here at CNBC. We see all this red. We see this big graph with color. Dow falls 350 points. And so the first thing I will tell you, the first step is to acknowledge emotion. Used to when I first started in financial markets and trying to help people on their journey, I used to think, well, if I can just give them the facts of history and share with people that, hey, this is totally within the normal bounds, that people won't be nervous anymore, or maybe even not nervous is the right word. Maybe it's just concern. I think everybody asks themselves two questions when markets go down, especially when they go down like they have in the last week and a half. The first question is there something I'm missing? Is there something wrong that's just seriously wrong? And to answer that question, you never know. I mean, markets can go up and down for no reason, or they can go up and down that's based off of a reason. The reason we've been given is that interest rates have kind of spiked, which means that maybe there's inflation. And so markets have gone down because they're worried about inflation, and as well as interest rates being higher. So you can invest in bonds and not have to invest in stocks. So the first process is for the emotion is actually turning off the website as I just did. The best thing that we can do is turn off the noise. But getting back to the emotion, I told you what the first question is. The second question is, why is this happening now? I've been asked that question just a few times. Most people haven't called me this time around, but I will tell you that if you are concerned, please call Charlie. Please call me. We always have our phones with us. We're happy to accept your call. But the why is this happening? Well, why did the market go up? Well, the market went up because people thought X, Y, and Z. Market goes down because I believe it's not just about the interest rates, but I believe also that now we have computer trading and algorithms, and I think that sometimes pushes the markets down a little bit faster. So acknowledge the emotion. Okay, that's the first thing to do. And so the limbic part of our brain, we can't help that we have it. All right, we all have it. People that have it disconnected to the rest of their brain through surgery or through some abnormality, they might not feel emotion. For the rest of us, sorry, this is a part of being a human being and being in investment markets. As Charlie and I always like to mention, though, this is the reason why you get higher returns for the most part, or at least higher expected returns with stocks and other types of riskier assets, is because not everybody wants to do this. In January, January was the greatest inflows of money into purchasing stock funds. And I just saw something recently that February has been one of the greatest outflows so far. It's only been, I guess, 9 days, but there's tremendous outflows now. So people bought all in January and they're selling in February. So this short-term emotional, visceral reaction is something that we have to deal with now. So that's step one, is admitting that there's some emotion here. If you're not concerned, I wouldn't ask you to be concerned because we're making this video, because the other two steps are all about putting it in perspective. So step number two, I'm going to pull up a chart here. This is the S&P 500 for the last 10 years. If you look year to date, this is what happened as of yesterday. Again, this is that visceral reaction of what's going on. But when we look over the last 10 years, the S&P 500 has had a 9.12% return. And I'm using here, the fund I'm using here is the S&P 500 iShares Core. So it's had a pretty decent return. I think most of us would take 9% return. If you look over here, this is again trying to make perspective. February 5th, it's down a little from the top. November was about, if I just eyeball it, was about the same price. So the fact that the market has just gone down, does that mean the market will keep on going down? Well, we don't know. And anyone that says they do know would be lying. So at this point, I do want to mention that we made a video in November, right before Thanksgiving, say why markets crash and what to do about it. And I even said then that I did not predict a crash, but I said we don't know what will cause the crash. We just know when markets turn over, sometimes they accelerate to the downside. So, but many times there's also these little blips right here. This was 2011 where the market went down. In 2016, which is right here, people were saying, this was the election year, people were saying this is a crash. And if you sold during that time period, you missed this tremendous run up. So that's the second part of it, is to ask yourself if there's really good evidence to suggest the market is going to keep on going down or go back up. Okay? So slowing down your thinking and thinking about the fact, do we really know what's going to happen? The other second part is getting away from the dialogue of the market is, okay? And when I say the market is, I'm using very specific language. But people will often say on TV, when people do call and they're upset, they will say the market is going down. So when you see this chart right here, what do you see? You see the market has gone down. It's not is going down. Market has gone down. Now today, the market is, has gone down so far today. So, what can we say? The market has gone down today, but using that dialogue of the market is really setting ourselves up for either regret or for affirmation that we were right. So when we say the market is going down, we're going to want to sell and get out. But if we say the market has gone down and we don't know, as I said a minute ago, which way it's going to go from here, is it going to go up or is it going to go down? I mean, this whole thing has been caused because things got so good in the economy, unemployment got so low that there's a fear of inflation. So we have to admit that we don't know what the next step will be. So the final thing I'd like to share with everybody is this 10-year, and I was around in 08, 09. I had just started, and it was very concerning. If you remember, peak to trough from 08 down to 09, the market was actually down 53%. This is not quite peak to trough, and it's showing 47.1%. But the market, when it started to go down, and it was a major, like, little down, and then we heard about the fact that property, subprime crisis, et cetera. But when it started to go down, every day you wake up and you say, I think it's going to come back. It's now priced in. It's now, and we don't know. We don't know. Again, we made the video in November about when markets crash, and we could say today that we knew this would happen sometime. Well, we did know it would happen sometime, but we have no idea when it's going to happen. And this is only a 10% correction. So we just don't know. But the important thing here, the third step, is to say, what are my goals for this money that I'm investing? Again, slow down the thinking and ask yourself, what are the goals? And that's the reason why Charlie and I talk about financial planning all the time. We talk about goals. We talk about when you're going to need the money. Because if you invested all your money in February 8th of 2000, February 12th of 2008, 10 years later, you're up 9% per year. You've done fantastic, okay? You've done fantastic. So again, that's a good thing. But if you look at the short-term gyrations, that's horrible. So what we really do, and this is again a human problem, is that we say we want to invest for the long term, and we say, yeah, we're willing to take the risk. But then when markets go down, we start thinking very short term. We need to go back and say, if this money is for retirement, that this money is for 2028, 2030. If you're in retirement, hopefully you've set up your portfolio so you have some cash, you have some shorter term instruments that will actually not go down. If they do, they will go down very little. But these stocks and these other riskier assets are really set up not for this year, not for next year. They are set up for the future. And so it's all about matching your investments to your investment goals. And again, in this situation, even though you lived through this 47% downturn, you actually, again, had a 9% annualized return. It's fantastic. So my final suggestion, those are the 3 steps. Go through the emotional part. It's natural. Then take a step back and think a little bit about how markets work. Think about the fact that we don't know if markets are going to go up or markets are going to go down. We really don't. You can get a feeling, but you could be wrong, like what happened in 16. A lot of people had a feeling that the market was going down. It didn't, and then they missed out. And then the third thing is to look back in historic periods when markets did go down. As long as you stayed invested, you were fully diversified. You must be fully diversified. If you're not fully diversified, yes, your company can go bankrupt. There can be a problem, but if you're investing in markets, as long as the world does not go bankrupt, you're not going to lose all your money. You may be down for a while, but you won't lose all your money. So again, Charlie and I are here to talk. We want to talk. If you're concerned, we can even just shoot the bull. But we want to let you know that this is our primary role as financial planners, is to help people set goals and then remind people when markets do great, that's great. You're going to have enough money for your goals. When markets do poorly, we still have a down. When markets go down, we still have that as part of your financial plan. And this is, as painful as it is, it's to be expected. So anyway, hope you're doing well. Kevin, CPA that does financial planning. Thanks.